Hi, I'm Jimmy. In this video, I want to walk through my analysis of Tesla, ticker symbol TSLA. So we're going to go through some numbers, and then we're going to dive into the quarterly earnings report that was just released a few days ago, and then we're going to see if we can come up with a fair value for Tesla's stock. Okay, so Tesla's stock is a tricky one to analyze because, well, I'm a numbers guy, and I like to let the numbers tell the story. But Tesla's numbers are really telling the story of crazy good growth, and they're putting off some question marks. So let's run through some basic numbers, and then we can see where it leads us. So this is a chart of revenue going back to 2008. But as you can see, revenue has really started to ramp up since 2013. And what's interesting about 2013 is that Tesla only produced about 22,000 vehicles that year. To put that in perspective, globally, there were about 85 million vehicles produced that year. So 22,000 versus 85 million. So the way I figured that, we could look at that one of two ways. First, we could say that they're hardly making a dent in the global market, or we could say it sounds like a really huge market for Tesla to go after. So production continued to ramp up all the way through 2018, where they produced just short of 250,000 vehicles. So clearly they're ramping up production. And this is a good thing. But now, when we switch over to net income, well, we can see that profits doesn't tell quite as good of a story. Now, I'm actually okay with Tesla losing money because we saw on the revenue chart, they're growing quite quickly. So clearly they're going to have to spend some money. And at the end of the day, I would expect that profits will eventually come. But for me, I'm a firm believer in free cash flow. And I believe that often free cash flow can paint a very interesting picture about the company. So as I get ready to release my first video in our valuation series that we're starting, well, I'm planning to publish the discounted cash flow valuation model very soon. I'm just finishing up a few things and then I'll release that. But I think that Tesla's story could be at least partially told by looking at their free cash flow. So this is Tesla's free cash flow going back the past 10 years. And as we can see, it hit a low point in 2017, but it seems to have recovered in 2018. Now we can't really see it because 2018's number is so small relative to 2017's number, but the actual number for 2018 was about negative $3 million. So where does this number come from? Well, this is the Tesla's cash flow statement for 2018. Came out in the fourth quarter of 2018. And I just want to give a rough and dirty way to calculate free cash flow using their actual cash flow statement and how we can examine it to help us develop the cash flow story. So just to recap the cash flow statement real quick, for those who aren't too familiar with how to read a cash flow statement. Well, the cash flow statement is broken into three main sections. The top section looks at cash flow from operations. And this is one of the most important sections in all of the financial statements because essentially what it does is it tells us how much cash the business generated from business operations, from general operations. The next section is the cash flow from investing. This is the middle section in yellow. Cash flow from investing tells us what the company invests in. So if they were to build a new plant or put on a new roof or repair machines, well, this is the section that appears. Then in the bottom section, we have cash flow from financing. This is where we can see if the company issued new stock or issued new bonds or paid back new bonds. This is where all of that lands. So to get free cash flow, this is a real quick and dirty way of doing it. Now, there are longer, more accurate ways of doing it, and we'll touch on those another time. But for now, this should work. So what we do is we take cash flow from operations and we subtract capital expenditures. Now, capital expenditures is how much the company invests, in theory, to maintain the business. So if they need to upgrade a plant or build a new one or replace a plant or buy new machines, well, this is a necessary expense to manage business operations. You can see this purchase of solar energy systems. They paid $218 million for it. Well, this was an add-on to their business, so it's not included in capital expenditures. Now, next year, assuming that becomes part of their regular business, well, the maintenance of that would go to capital expenditures and would impact free cash flow. So this is where we get free cash flow. It's the 2097 minus the 2100. And we get free cash flow of about negative $3 million. So the concept of free cash flow is how much cash does the business generate? You subtract how much cash you need to spend to earn that cash. Whatever's left, in theory, is free cash flow. Now this brings us to the most recent quarter, and then we'll jump into coming up with a fair value. So if we were to look at the first quarter cash flow statement, well, we can see that capital expenditures were about $280 million. And net cash from operations, well, that came in about negative $639 million. bringing free cash flow to about 920 million, well, negative 920 million. Now, I was really disappointed to see this because I was hoping to use free cash flow or projected free cash flow to try to value Tesla's stock. But with these kind of swings in free cash flow, it would make any projections extraordinarily unreliable. And there's actually one other thing that I wanted to point out about their cash flow statement that I noticed was a bit unusual. So capital expenditures was about $280 million. And if we look up here, well, this is depreciation, amortization, and impairments. Now, generally speaking, these two numbers should be about the same. They should be right near each other. Because let's say that Tesla goes out and they want to build a factory. Well, that factory is going to cost them, let's say, $1 billion. And we would see that appear in the cash flow from investing section. But then they would have to depreciate the cost of building that factory. So maybe that depreciation is, let's say, $50 million a year. That $50 million would appear in the depreciation line. That's also why this number appears to be a positive number. Because in order to calculate cash flow from operations, we take net income and we add back non-cash charges. Depreciation is an expense that already appeared on the income statement, so we add that back since it wasn't actually a cash outlay in this year. But depreciation is very much a real expense because that factory is going to have to be maintained. Because in theory, depreciation would tell us how much in maintenance that factory would need. Well, capital expenditures shows how much is actually being paid out in cash to do those repairs. So in time, these two numbers should be about equal to each other, say within 10% of each other. Well, these two numbers are pretty far away from each other. Now, these numbers are just quarterly numbers, so I don't want to overreact to any one quarter, but this same thing happened in the fourth quarter last year as well. So I think that it is worth for us to watch. It's worth watching. Because if you ever wanted to legitimately make free cash flow look better, well, one thing you could do is just stop making repairs or make smaller repairs, and you'd have smaller capital expenditures, and free cash flow would look better. But eventually, you're going to have to make the repairs on that building, and the pendulum would swing the other way, and now capital expenditures would be bigger than your depreciation cost. So at that point, free cash flow would look smaller. That being said, I'm not bringing this out to imply that Tesla's doing anything like that. I don't think that they are. They're a young company. They have a lot of moving parts. So there's going to be a whole bunch of things moving in and out of investments. For example, they have the Gigafactory in Nevada. Then they're also putting up another factory over in Shanghai that's supposed to go live in 2019. So I'm guessing in time, all this stuff will shake itself out. I just wanted to bring this out as something to pay attention to in general for any companies that we research. And it reaffirms our belief that free cash flow is going to be very volatile going forward, and it will be very difficult to use free cash flow to try to value Tesla stock. So what else can we use? We can't use price to earnings because they're not profitable. They don't have a dividend, so we can't use a dividend discount model. So we could get away with doing price to sales, but I think that price to sales is a fairly weak method of coming up with a valuation because it doesn't account for any profit margins. So I think that one choice that does make some sense is to use enterprise value to EBITDA. This is a chart of EBITDA going back to 2009. And as we can see, in 2018, EBITDA turned significantly higher. And when we add the last 12 months, well, we can see that it still seems to be moving higher. Now, the last 12 months is really just a way to include the first quarter in that. So EBITDA there adds the first quarter of this year and the last 3 quarters of last year, and then we end up with the last 12 months. But in the first quarter of this year, it did improve over the first quarter of last year, so I expect EBITDA to stay positive. So once again, I'll have videos on enterprise value to EBITDA as soon as we start our valuation series. But for now, let's look at the next 4 quarters according to analyst estimates for EBITDA. And we get an expected EBITDA of about $3 billion. We take the current enterprise value, there's a calculation for that, of about $59 billion. We divide that by EBITDA, and we end up with a forward enterprise value to EBITDA of about 17x. Now, here's the real issue. It's currently 17x, but what should it be? We can't use peers. General Motors has a forward EV to EBITDA multiple of slightly less than 3x. Ford is right around the same thing. Fiat Chrysler is less than 2x. So we can't even use Tesla's historical EV to EBITDA average because as we see, the EV to EBITDA numbers have been quite volatile in recent history. So the best I could come up with was to find as many analysts as I could that they had reports and that they published what they used, what multiples that they used. And from what I could find, it seems that 16x would be a reasonable number to use. And since that's less than the current level of 17x, well, right away, we know that the value of Tesla's stock is going to be too high right now. So at 16x, the fair value of Tesla's stock would be about $200 per share. And Tesla's stock is currently trading at about $240 per share. Now, if you happen to see my recent video on when to buy a stock, well, you may have heard that typically I think it's smart to apply a personal, whatever our personal margin of safety is, to any fair value calculation. And we should base that on our confidence level in that calculation. And for me, on a personal basis, well, I have very little confidence in this calculation. It's the best we could come up with given the limited choices, but ultimately, this means for me that I can't buy Tesla stock, which is a shame because I actually think that there's a pretty good chance that Tesla stock will move higher. And that's because of the general awesomeness of their products. And I'm a firm believer in what Tesla is doing to the car market. I think that what they're doing with electric cars, what they're doing with Solar City is the future. The questionable part for me with all of this is how long before it becomes part of the mainstream future. Right now, owning a Tesla is mostly a luxury. And until those products go mainstream, I'm going to have trouble paying such a high multiple, despite the fact that Elon Musk is a genius. And I think that the way he operates the business, although at times there's question marks, I think that it's heading in the right direction. I like where he's trying to go with it. But from an investment standpoint, there just is too many question marks to me. So, what about you? Do you think that Tesla's stock is actually do you think it's a good buy here? If not here, at what level would you get involved? Let me know what you think in the comments below. If you haven't done so yet, hit subscribe. We're going to be doing our valuation series very soon. So hit subscribe and hit the thumbs up. Thank you for sticking with me all the way to the end of the video. I'll see you in the next video. Thanks.